All right, so production process, we were working through different steps in the process itself, and we left off last time. Let me find the right slide here. I'm going to back up just a little bit. We were talking about the elements of the production order itself. So we talked about the planned order. We talked about how the planned order serves as a trigger for the process. We talked about how we convert a planned order into a production order for the sake of actually beginning production. And one of the big points that we made about a production order that we will see a lot in our discussion today is that a production order is a cost object. And what does that mean? What's the significance of saying something is a cost object? I know it's the day before Thanksgiving, or 2 days before Thanksgiving, but got to hold on for another day before you go on vacation. What's the significance of saying that something is a cost object? You've answered this question before when I've asked it, so I don't think it's that hard. Okay, it impacts financial accounting. That's true. That's true. That's always a good default answer. What's that? It accumulates costs until they get settled at some point in the future. A cost object is a critical element both in financial accounting and cost accounting, as it is a document that is a live document that accumulates costs. So you'll notice that right here, one set of fields on the production order are what are our planned costs for this production run, but then more importantly, what are our actual costs? And that maps back to this idea of it being a cost object. As we do work on this particular production run, all of our worker times, the cost of those workers, all of the materials that they used, all of that information is going to be accumulated on this production order until we get to the end. And at the end, we are going to settle this production order. And although there's a lot of important facts on this production order, two of the most important elements are what did it actually cost us? And then at the very end, what did we actually produce? How many units? And so those are some of the most important facts that are going to come out of the production order. And so we left off last time talking about the fact that when we create a production order based on historical information, the system will estimate what the cost of this production run is because it knows the materials that we are going to use. How does it know the materials we're going to use? Okay, all right, that's going to be a factor in this, but what else is it going to use most heavily? The bill of materials. Okay, so the bill of materials is going to be very critical here because it's going to tell us what materials we're going to need and in what quantities. And so from that, it will estimate the material cost. And then labor cost, where is it going to get this information from? No, it's going to record it in the cost object, but where is it going to get what's the source data for this? What's the brother or sister to the bill of materials in production? What's that? I heard the product routing, okay? So the product routing tells us what steps we're going to do and how many people are going to be involved and how much time is involved. So it's going to use the bill of materials to calculate the material cost. It's going to use the product routing to calculate the labor. Now realize that this is, in some respects, the ideal scenario because this basically says if we use exactly the right quantity of materials and if we take exactly as much time as we should take, then it's going to cost us this amount right here. And depending upon what the operation is and how mature we are as an organization and how systematized we are, that may be a really good estimate Or we could be off by a few $100s perhaps. Maybe, it's 2 days before Thanksgiving and all of our workers are moving at half speed throughout the factory. And so the labor cost here winds up being twice what we expected. Or maybe one of our workers was clumsy and ruined some of the materials and we had to request more materials. And so our material cost winds up going up. To a certain extent, you can imagine that typically you're not going to see the material costs be lower. Something would be wrong if they came to us and said, yeah, we made those 1,400 bicycles you asked, and we had 700 wheels left over. It's the oddest thing, so I guess we can send those back. Sounds like we made unicycles instead of bicycles. I don't know, but you can imagine you're not going to typically see underages, particularly with material, but there could be variances here, which is what's going to get captured on our cost object, which is going to get captured on the production order as we proceed. But this is what we start with. This is our plan for what this production run is going to actually cost us from a financial accounting perspective. Now, when we authorize production, and I don't know if we already did this slide or not because I have ink on it, so maybe we did. We schedule the things, we do the availability check. Yeah, we did do this. We talk about the reservations for the materials. We put in reservations for those. We do the preliminary costing, which is what we just talked about 30 seconds ago. And then if we need to do some things, we issue purchase requisitions. You might say, why would we be issuing purchase requisitions at this point? Well, remember, production runs could take hours, or they could take days, or they could take weeks. We don't really know what we're making and how long this production run's going to be. So hypothetically in our organization, there might be some things that we don't actually purchase until we begin the production process, because that's going to be plenty of time to allow those things to come in. Now, this is getting among the more detailed facts about this process, but what's actually going to happen is when we create the production order in the system, the status next to it is going to be what you see here, CRTD created. And what will then happen is when that production order gets released, which changes it to REL status, is when the steps are going to begin to be executed. So if you think about this in terms of your ERP SIM experience, you started with a bunch of planned orders, and then perhaps you sent a bunch of production orders to the factory. Well, at that point, you put those production orders in the created status. But the factory's not going to start work on all of those simultaneously. They're going to have to schedule the work and sequence it, and at least in the context of ERP SIM, they did things basically in the order in which you released them. So given that situation, when the factory actually begins work, they'll change the status to released, or REL. And a lot of things are going to happen at this point. The various steps are going to trigger goods movements of materials. Raw materials, semi-finished goods, and so on are going to come out of the plant, or actually out of the warehouse, and go to the plant for production. We're going to start seeing confirmation of activity in the production process. We're going to have documents printed and other things like that to go along with the production run. And then when all is said and done, we're going to see settlement at the end, which is when we kind of take accounting of the end results of what actually happened as a result of this production run. So the order gets created and released, as we were just talking about. There's a lot of this at this point now that can happen automatically or manually. It kind of depends on, how much control we want to exert over our production system here. So if there's no time gap here, then we can set it up so that as soon as we create a production order, it is immediately released into production for them to begin work on it. And that's essentially what happened in the context of ERP SIM, where you created it and it immediately went to the factory for them to begin work on it. The other thing that we could do is we can do manual release of either the entire production order, or we could release specific operations. So imagine this. Imagine we have a production run we have to do. And as we look at the product routing, there are 8 different steps. And we look at those 8 steps and we say, okay, this production run is actually going to take us 4 days to accomplish. But we're going to be closed for Thanksgiving. So let's think about this. We have 8 different steps here. Let's do the first 4 and then stop and then pick up with the last 4 after everybody comes back for Thanksgiving vacation. So we can do that. We could actually just release certain operations and then leave the others at that point still partially released, waiting for us to come back and say, okay, now we're going to finish this up. So the point of this is you're used to the idea that when we send something to production based on your experience, we send the whole thing and the factory just takes over and does the entire process. What this is saying is if we want to in our organization, we can be really, really fine-grained about this and just release certain steps of a production order to be done. So you could imagine, for example, you have 2 different production runs. You're going to do steps 1 through 3 of production order 1, and then you're going to switch to production order 2 and do steps 1 through 6. We can do things like that if we want to, based on how we actually release the production order and whether we release the whole thing or we just release particular steps or operations from the product routing. One of the key things that happens here is the goods issue to production. So that's going to happen in order for us to be able to engage in production. I'm not going to ask you this number on a test, but just as a point of fact, this is goods movement type 261, goods issue to production. It's something that we will do a whole lot of, and it has some rather significant impacts. We will see material documents created, financial accounting documents, and cost accounting documents created. Okay, let's review this because this is an important fact that might show up on the exam, or probably will show up on the exam would be a better way to put that. What does the material document tell us in this situation? What's it capturing? That's true, but what else? There's a key fact that a material document will have on it in this situation when we issue materials. Right idea, but no. Material documents capture quantities of materials. So now, Roger, what does the FI document capture? This is where we see the cost, okay? So the FI document is going to be reflecting the cost of these materials. The material document is going to be reflecting the quantity. So when the goods get issued, we're going to see those documents created because now we've got to update our inventory levels. So the material document will do that for us. And as we see here in a moment, there's going to be an accounting posting associated with this. So the FI document's going to give us that. Based on that, we're going to see some general ledger accounts updated. So this is the posting that I just alluded to that we'll talk about here in a moment. Our inventory is going to be updated. And keep in mind that although the value of materials and the count of the materials are in some respects parallel, they're tracked differently. And as we just observed, quantities are tracked in material documents. You don't have a general ledger account that shows you the quantity of things that you own. you have general ledger accounts that show you dollar values or some other currency-based values. So we're going to update the value of the materials that we're issuing here. We're going to update the counts. And if we presumably had reservations for these materials, then those are going to be updated. You know, we're no longer, we're either, you could view it as we're going to cancel the reservation or we're going to reduce the reservation. But nonetheless, we reserved materials and now we're fetching them and issuing them. So that reservation will be canceled. And then at this point is where we now have a very important fact. And that is, in the planned order, or excuse me, in the production order, as we observed a few moments ago, there is an estimated cost of the materials in this production run. But that was an estimated cost. It is at this point we now know the actual cost of those materials. It is reflected on this FI document. The FI document is going to take care of the general ledger posting here in some respects, but the other part of this is the costs are updated because our production order is a cost object. And so the production order is going to now have recorded on it, okay, you said the planned material costs were going to be this, here's the actual material costs based on what we actually now just pulled out of inventory, okay? This slide right here, I'm just going to skip over because it just summarizes exactly what I just had on the last slide, which is what happens here when we actually do the goods issue. So same thing here, date in the goods issue. So let's jump to this slide right here, which is, okay, here's our first financial accounting posting in the production process, which is the financial impact of goods issue. So notice what's happening here. We are reducing our inventory levels. So we're going to be crediting inventory accounts, account or accounts, depending upon how many accounts we need to use representing the materials we're using. And notice the corresponding debit is to a consumption expense account. So what's being illustrated on this particular slide is, in this particular production run, we're using $9,237.50 worth of raw materials and $5,750 worth of semi-finished goods. We might only, in a given production run, only be using raw materials, in which case, just pay attention to the top two lines. But this is illustrating sometimes in a given production run, you'll use more than one type of material, and so you'll be hitting more than one type of asset account. So this should make perfect sense to us. Inventory accounts are asset accounts. The native balance of an asset account is a debit, representing how much of that asset we own. We're now pulling assets out of inventory, which means we've got to deduct them. And so we credit the asset accounts, reflecting that withdrawal from inventory, and then the corresponding debit, once again, as illustrated here, is to a consumption expense account. And you'll notice that in this particular general ledger, we have raw material consumption expense and semi-finished goods consumption expense. So this set of general ledger postings happen when we do the goods issue. And notice down here now, this is illustrating our updating of our cost object, updating of our production order, as it says right here. And so our planned cost was $14,500. But apparently, at least some of this is more expensive than we thought, because our actual costs are $14,987.50. Notice our postings are based on the actual costs. Now, this particular table here that the authors have created, I would encourage you, because I find it actually creates more confusion than it's worth. Um, I would just ignore this reference here to debit and debit minus credit. I think it just adds confusion. It should be pretty clear to you what's going on here. These were our planned costs, and at this point now, this is our actual cost of the material. Because one, we're working with an estimate, and the other, we actually know the value of the materials. By the way, keep in mind, how do we know the value of the materials? Remember, we value materials two different ways. What are the two different ways we value materials? Moving average, good, and standard. Okay, so depending upon how we have defined to do this, then that's going to be used to value the particular material, and the system's just going to do math. You withdrew this many units of whatever at this cost per unit. Do the math. You have your posting there. All right, so now we do the production. What is actually going to happen here is there are two levels of confirmation. When we are done, the entire production order is going to be confirmed. So there's going to be somebody whose job it is to say, you asked us to make 15,000 bicycles, we made 15,000 bicycles. And that is the production order level confirmation. But we also have, as we've discussed for a product routing, that says that there are individual steps. Well, every step in the routing is also going to be confirmed. Okay, I just finished step 2. Okay, I just finished step 3. And we're going to be capturing that information so that we have times and we have dates and we have quantities so that we can actually replay, if we wanted to, the various facts in the overall production run. Yes, sir. Roger. Different companies are going to handle this in different ways, because remember, we want to have flexibility here. So we might very well see that the people that work in the factory, they get told you make 50. And so the production order goes through for 50. And they know that they're going to be given enough materials to make 50. And if something gets messed up, they may actually at the end only confirm that they made 49. And that might be the way we would want it to be handled. In other situations, it might be something where we tell them to make 50, we need 50, and so if they mess something up, they do a request for additional goods issue from the warehouse, and replacement materials are brought over. We have flexibility in that regard. If we need a supplemental goods issue, we can certainly do that. That would just be in another goods movement, and it would add to the goods issue done previously. Otherwise, we would just handle it with the confirmation. And you do sometimes have a situation where you ask for 50, and you give them enough raw materials to make 50, and somehow they make 52. You know, that could be something probably not happening with bicycles, but with some materials maybe that are hand cut, and the person doing the cutting actually cuts them a little smaller than they should have, and so you get 52 instead of 50. Variances like that are not uncommon, but they're going to differ from what we're making in our factory operations, and we would just have to define how we want to handle that in the context of our company. Other questions? Yes. They can. I would suggest that they would probably wait until the steps that we're about to talk about to capture it. Um, there's planning in the context of what you post to the general ledger, and there's planning in the context of apart from the general ledger. If we back up to this right here, we can't, we don't, this is based on the materials that we actually pulled out of inventory. So if it's like bicycle tires, and we know that you normally put 2 on a bicycle, but we also know that typically 4 are defective. So if we pull out those additional 4 and actually send over 104 tires to make 50 bicycles, then that would be reflected here. But apart from that, this is just totally reflective of what gets issued to production by the people in the warehouse.
So in the plan section, with the cost for the estimate, we know historically that we have added costs a certain amount. Would it be possible to include that into the plan estimate?
What you would probably do, and once again, there's all kinds of different ways a company can handle this. You could say something like on your bill of materials that a bicycle, you have a line item for 2 tires. And then somewhere else you might have a line item for 0.05 tires. Knowing that, every 20 bicycles you make, there's going to be an additional tire needed due to scrap or something like that. You could do something like this. I think you would find that most manufacturing enterprises work really, really hard to drive stuff like this out of the operation. Other questions? All right, so now we're at the end. We've done our production run. We've done our confirmation, like I encouraged you to do a second ago. Let's just ignore debit, credit, and this stuff right here. So what we have now is we look at our production run, we look at the cost object, and like we said a moment ago, our material costs were $14,987.50. So we had a cost overrun, and sure enough, it took us a little bit longer to make this. So our actual labor costs here were $645.83. This is why we do confirmations at every step. Remember, every step on your product routing, and you did this for a lab, has a time associated with it. We know this should take 15 minutes. Well, workers check in and check out of particular jobs, which in most instances doesn't mean they're going to run an SAP transaction, but it could mean that in their workstation they have a set of buttons. And when they start work, they push one button, and when they're done, they push the next button, and it takes the unit away, but it also keeps track of how much time they spent on that unit. And the system records it for them automatically. So we can see in this situation, our labor cost was a little bit more than we expected, meaning that our total cost of this production run was more than we anticipated. This is a very important fact. Why is that a very important fact to us in the big picture? Why do we need to know that? Okay? And why is that important, though? Yeah, now all of a sudden, what is this in the context of our financial statements going to ultimately bubble up to? Cost of goods sold. Okay, so our cost of goods sold, at least for these units, is higher than we anticipated. Is that an important fact? You better believe it. Because depending upon what our margin is for every item we sell, we may need to raise the price here a little bit, hypothetically. So our actual cost here is more than we anticipated. So we'll talk about how we're going to handle that from an accounting context in a moment here, but let's look at one other aspect of being done with our work first, and that is we finish our work and we send the results back to the factory. So the factory the warehouse did a goods issue to us of raw materials and semi-finished goods. We are now going to send back to the warehouse finished goods. This is a goods receipt into storage. So this is movement type 101. So from the perspective of the people that work in the warehouse, they send the factory raw materials and semi-finished goods, and then a couple days later, the factory sends back finished goods. In the ERP sim context, we send the factory oats and blueberries and boxes, and they send us back finished goods. So there's going to be an impact of this particular goods receipt. There's going to be a material document. There's going to be an FI document. There's going to be CO documents for the same reason as before. The material document is going to update the quantity of finished goods that we now have. The FI document is going to update the dollar value of those particular goods. And the CO documents are going to capture the cost facts, which will parallel the FI document. We are also going to be updating two other things, and that is we're going to be updating the material master. Two things. We're going to update the quantity of the material master, and this says the value of the material master. What else could potentially get adjusted here on the material master that relates to value that we were just talking about a couple of moments ago? The cost, okay? If we're using a standard cost for this material, we don't change it. Standard costs only get adjusted periodically as a part of a special calculation we do. But if we're doing a moving average cost, this would be a time that we could update that cost value based on the actual cost of this production run. So the material master is going to get updated, and then the production order, it being a cost object, is going to get updated with the key facts. We're going to record the quantities that we made, the date in which those things got made, and the cost information that we were looking at in the table a couple of slides ago. All right, so I'm going to skip over this, and so now here's this. We already built in, kill off this text right here because, quite frankly, I find it confusing and don't know why it's there. I think the math here is pretty straightforward. We planned on this costing us $14,500. It actually cost us $14,987. I have no idea why this other column is here, quite frankly, because that other column right there is just a reproduction of the planned column, okay? But the point is, the difference between planned and actual is our variance. So you can see here, you know, just forget this column even exists, okay? So the difference between planned and actual is our variance. So we did a posting before related to goods issue, and that was based on the value of the material we pulled out of the warehouse. Now we're sending finished goods back to the warehouse. So before we look at the numbers, the postings are pretty straightforward. We now have more finished goods than we did a moment ago, so we're going to be debiting an inventory account, and the corresponding credit to offset that is to manufacturing output settlement. So the only really interesting thing here is, what numbers do I use for this posting? And if you look at this slide, what you will see is the numbers that we use are the ones that were on our plan, not on our actual. So we were expecting the factory to make us materials valued at $15,125. It cost them more, but we're going to do our inventory valuation based on our plan. So the debit is based on the plan. The offsetting credit to manufacturing output settlement is based on the plan. Now, at that point, that should raise an obvious question, which is, yeah, but reality is $508 different than our plan. What's going to happen to that? And that's going to be a different calculation. And I'm actually going to jump to that because it doesn't show up for a few more slides. And then we will back up here. Okay, so settlement. The difference between our planned and our actual costs, the variance here. As we said a moment ago, only planned costs are posted in the goods receipt step. So when the materials were sent back to the warehouse and they received it, that posting was done based on our planned costs. Now we have to settle the variance. And the whole idea here is, and this goes back to the question that was asked before, we want to keep track of this variance. We don't want to just overvalue the materials and lose the fact that our production people weren't as efficient as we had hoped. So what we're actually going to do here now is we're going to take the variance, the difference between planned and actual, and we are going to post to two different accounts here. Whoops. Manufacturing output settlement variance and manufacturing output settlement. So we debit manufacturing output settlement variance and we credit manufacturing output settlement. Now notice, based on what's shown here, this is manufacturing output settlement now has the actual value in it. But what we did is we split the debit essentially, where the bulk of the debit, the $15,125, was a debit to an asset account, but the discrepancy amount, the variance here of $508, is going to be settled to this manufacturing output settlement variance. This, therefore, is going to give us an account in our general ledger that's going to let us track whether our factory is underperforming or overperforming, and by how much. You know, in an ideal world, we wouldn't even have to do this posting. But it's not going to be unheard of for there to be a variance, particularly if we're keeping track of people's time and working on a job and other things of that sort. But obviously, we want this to be a really, really, really low number. So if we get to the end of the quarter and there's $250,000 sitting in that manufacturing output settlement variance account as a debit, we need to be calling in some plant managers and figuring out what's going on here. Because we want this, we expect this to be zero or close to it. Now realize the same posting would happen if there were negative numbers involved here. Maybe, for example, we got a really, really good deal on some of our materials, and so our actual material costs were less than our plan. And maybe our workers drank a bunch of coffee one morning and worked really, really extra fast, and so the labor costs were less than expected. In that case, we would have a negative variance. Well, we'll take a negative variance. A negative variance is good news. We're still going to post it the exact same way. We're still going to debit and credit the accounts that you're seeing here, but it would be for a negative number. Now, the fact is that debiting a negative number is the same as crediting, and crediting a negative number is the same as debiting, but we don't have to worry about that. We just set it up as an automatic posting, and the system will automatically do the adjustments for us here in that respect. Questions about this? Yes?
Would it be common for companies to have multiple variance accounts
We could absolutely do that. We could absolutely do that, in which case this would be 2 entries instead of one, and you could see exactly how it would work here. We could also have, if we wanted to, multiple variance accounts associated with different factories, if we wanted to do that. You want to avoid too much of that because this is going directly into a general ledger. I could see where in some situations where if you wanted to create a situation where you wanted to track this, you could even do something with this being a reconciliation account and you're doing some sub-ledger kind of operations. We won't get into that, but you could very easily create that kind of structure. Questions, comments? All right, we skipped over. Let's pick up a couple of facts that we skipped over here just for, and then we'll kind of be done here, or at least close to being done. There are some overhead calculations related to production that are only captured periodically. For example, indirect costs related to management. I said in my example, imagine someone working on an assembly line, and every time they do work, they push buttons, and so the system keeps track of time, and so we know exactly how much the cost was of making certain things. Well, that's all true, but there's also a team of supervisors that expect to get paid, but they're not clicking buttons, and their time isn't being tracked against particular production orders. So periodically, we will calculate these overhead items, utilities, electricity, water, things like that. Those overhead items don't go directly into the cost of goods sold, but are going to be accumulated for the sake of our financial reporting. And this is where we use cost centers. All of these overhead items, all of these indirect costs are going to be accumulated in these cost centers. And periodically, they're going to be allocated to production orders based on predetermined rules. Just to keep it really, really simple, this last month, all our supervisors put together got paid $50,000, and our utilities cost was $500,000, and we did 50 production runs, all of the exact same size. Okay, well, we would just say, okay, well, that being the case, then each of those, we're going to add $1,000 to it to cover the cost of the supervisors, and we're going to add $10,000 to it to cover the cost of utilities. And so now we have a more complete understanding of what our actual overhead is here. The more that we want to dig into this, the more that we are now in the world of cost accounting, or really cost accounting and profitability analysis. And as we have mentioned before, there are some organizations that will have entire teams of people that focus on this aspect of our operation, because the more we understand this and the more we can reduce these costs, potentially the more profitable we can be in our organization. There are certain calculations we have to do periodically. One of those is a work in progress determination. If you think about it, this is the difference in, we have a period of time where we have sent materials to the factory for them to work on. We've issued them the materials. And at some point thereafter, there's going to be materials that come back to us in the factory. Well, imagine this. We issue to the factory $100,000 worth of stuff. And at some point in the future, they're going to deliver back to us $150,000 worth of stuff. But in this intervening period, our accounting records show us having $100,000 less of stuff than we actually have. Just because we issued it to production doesn't mean it disappeared. It means that it's just sitting there on the production floor being worked on as opposed to in racks in our factory. So if we get to the end of a closing period, we have to account for the fact that in this gap here, it looks like materials just disappeared in terms of our general ledger, but they really didn't. And so we will periodically have to value what is actually in the midst of the production process. And we will post that value to the general ledger. And this is something that we don't have to do in a lot of instances. If our production runs are very, very short and there's not a lot of asset value here, we might be able to get away with not even doing this if the value of the materials is not high. But if the value of the materials is high and production runs take an extended period of time, then this work in progress determination might be something that we have to do. For example, maybe we're talking about building an airplane, and we just issued the factory $5 million worth of raw materials, which on our balance sheet makes it look like the value of our company just went down by $5 million. Investors aren't going to like that. If we are at a point in time where we are getting ready to publish our annual report and we want our general ledger to be both accurate and make us look good, we would probably want to value those materials even though we've issued them to the factory. So that's a work in progress determination. It's not something that we would typically do on a daily basis or anything like that, but as a part of quarterly closing or year-end closing, we may have to make these kinds of calculations to bridge the gap that is created here between goods issue and goods receipt. Questions? The only thing left in this chapter is a section here on the fact that there are different kinds of reports that we can get out of our ERP system to help us monitor what's going on in the context of production. We have online lists, we have work lists, we have analytics. Remember, work lists are the kinds of things that tell people what they're doing in their job. So a list of all the production orders that you're going to be working on today would be a work list. An online list would be more akin to, show me information about the production status. And so here we see, for example, a production order, and we see the materials that are going to be a part of those production orders and the date that they're actually required to be delivered to the factory for the factory to start work on them. You notice every one of these things has the same date, which suggests that this is a bill of materials and product routing that assigns everything to the first operation. So all of this is going to be delivered to a particular plant on this particular date. You can see that this has actually been released, and so the factory is working on it. If it were done, we would see a different status there. We'd see confirmed, but we don't. So this would be an example of the various transactions that we can see in a system to monitor what's going on here. And you can see here, it looks like this is now the order, the various steps in the product routing. And we can see this has been, it was released, the operator started work, and it was confirmed. So we can see that everything here has actually been confirmed for this particular production order, whereas the second production order has been released, but doesn't look like any work has actually started on it. So you can imagine if you're a plant manager you could actually check the status of given production runs if you have the automation set up for such in your factory, where as individual steps are done, the system's going to capture that information and do the posting. One of our students who graduated a few years ago took a job for a manufacturing operation here in this area, and one of his jobs was to go into the factory and put into place the various postings that would happen that correspond to employees actually pushing buttons. So literally, the person who's doing material staging, all that person is told is, when they bring you the work, stage the work, and when you're done, push this button, and the conveyor belt will take it on to the next person. Well, that's all they know. But behind the scenes, when they push that button, the status of this particular step on a given production run gets changed to confirm. And that was his job, to go through the entire production line and sequence all of the different postings that would happen. So it's a good example of, there are a lot of people whose jobs are controlled by a back-end system, but they don't even see it. To them, it's totally transparent, but their work is actually being tracked in the transactions in the system. It's an example of the stock requirements list. I think this is actually transaction MD07 that tells us for deluxe touring bikes, we actually have 0 in stock right now. We did sales forecasts, and we have independent requirements of 168 units times 2. So we now have a deficiency of 336 units. We have 3 planned orders that are set to be made, 168 units, 168 units, and 235 units. And you'll notice another independent requirement here at the bottom for 235 units. So when all is said and done, we're not going to have anything left if our sales forecasts are accurate here. So this is a view of production from a material perspective. And that is it for our discussion of the production process.